Welcome to episode 4 of the ICT Mastery Blueprint, a series where I'm basically going to be teaching you guys everything I know about ICT from step 1 to step infinity. This is episode 4. We're going to talk about internal and external range liquidity. If you have not watched the previous 3 episodes, this episode will not make too much sense for you. We used a lot of the concepts in the previous 3 episodes in this video, so I would highly recommend watching those first 3 videos first. Basically, I taught you guys about liquidity and imbalances. Today is going to be our first day where we're implementing the two together and utilizing them in your trading. Let's get started. As you guys know, I don't like to waste any time. Minimize myself here, and we can begin. So, first things first, what is internal and external range liquidity? Internal range liquidity simply refers to liquidity that is resting inside of a dealing range. So this can refer to 3 types of things. This can refer to short-term lows and highs. This can refer to fair value gaps and order blocks. Now, a lot of people don't know this, but yes, order blocks is a form of internal range liquidity because that is where orders are paired by smart money and the algorithm to send price lower. Similar concept to the fair value gap. External range liquidity refers to liquidity at the extremes of the dealing range. This refers to buy side and sell side liquidity resting above an old high or low. So you guys should already know this. We talked about this. This is simply your buy side and sell side liquidity pools. Now I will say, if you do not know about order blocks, you don't need to worry about that right now. That's going to be covered in 2 videos. The next video will cover breaker blocks. The video after that will cover order blocks. So don't worry about that too much right now. All you need to know is that internal range liquidity refers to short-term lows and highs, fair value gaps, and order blocks. So this concept is subject to change to the context and current range you are looking at. So for example, price can be trading from monthly internal range liquidity, but external range liquidity on the daily chart would be being met. So internal and external range liquidity is all subjective to the time frame you are looking at or the time interval you're looking at. And I'll go over that in this video. So here's a simple depiction of internal range and external range liquidity. You can see we have a fair value gap and an order block right here. Price trades up into internal range liquidity and then seeks external range liquidity, which is a sell side liquidity pool resting at this old low. And then same thing on the other side, price comes into this internal range liquidity. So we have a bullish order block right here and this bullish fair value gap, which is a internal range liquidity pool. And then we go higher towards the external range liquidity pool. So a simple retracement and distribution kind of pattern, you could say. So how do you identify internal and external range liquidity? Internal range liquidity, when there is a current trading range, meaning there's a certain high and low put into the marketplace. Internal range liquidity refers to the fair value gaps, order blocks, highs and lows inside that range. So any move inside that range, when you have an established trading range, is your internal range liquidity. External range liquidity refers to the extremes of the range, so the range low and high. This is where your sell side and your major sell side and buy side liquidity pools at the range high or low are resting. So for example, here you have a established range by this purple and green box. So imagine this is your trading range. You can see at the low of the range, we have sell side liquidity, which is external range liquidity. And over here, we have the high of the range. So you can see price trades into this internal range liquidity pool, which is a fair value gap and an order block. And then we seek external range liquidity, which is the sell side liquidity resting here. Same thing on the other side. We have this trading range defined by this low, right? And we have an old high here. So this old range, price expands, trades into this fair value gap, which again is a form of internal range liquidity. And then we expand higher, seeking external range liquidity. So what is the importance of this? The first thing you need to understand, and please remember this because this is how I determine my bias every single day pretty much. The market moves for 4 reasons. Anything else anyone tells you is incorrect. There are only 4 things the algorithm can price to. 1, external range liquidity. It can move higher or lower to external range liquidity. So that's 2 ways it can price. Higher or lower to external range liquidity. The second way is higher or lower to internal range liquidity. That is simply it. We are either seeking a liquidity pool resting at external range liquidity, or we are seeking a form of internal range liquidity inside of a trading range. Price will move Now this is the relationship between the two. Most people know this. Price will move from external to internal when the range is likely to remain, meaning if we have an established range, right, and the range is likely to remain, price will seek from external to internal. And price will move from internal range to external range when the range is likely to expand. That part and component is important. A lot of people don't understand that. You have to understand the range that you're trading in. You can't always anticipate internal to external on a given time frame when the higher time frame range, or a range that you may not know you're trading in, is not established with the same context. So we'll go over that when we go over the examples. So for example here, internal range liquidity, price seeks is the fair value gap right here and this order block. We have external range liquidity right here. Price takes out external range liquidity, and because this range is likely to remain, we seek internal range liquidity, and then you would expect external range liquidity if you expect the range to expand. That is the key. If you do not expect this range to expand, then you do not expect internal to external, right? That is a criteria for this kind of concept. Over here on the other side, you have an external range liquidity pool right here. Price takes it out, and because the range is likely to remain, we seek internal range liquidity. If the range is likely to expand, we would then see external range liquidity in the form of this new range. So how you can use it to determine bias. This is a very, very important part in determining bias, because this is basically to determine where price is likely to go. Understanding on the higher time frame if we are likely to seek internal or external range can be a large factor in determining bias. When the monthly, weekly, daily draw is external range liquidity, the lower time frame will offer internal range liquidity towards the higher time frame draw. When the monthly, weekly draw is internal range liquidity, the lower time frame will offer external range liquidity towards the higher time frame draw, which is IRL. So I will go over this. You might have to read this a couple times, but once you understand this, you'll understand how to determine bias some of the time. This is only one of the things I use. And then remember, very crucial, remember, external range liquidity runs and internal range liquidity runs can either be low resistance or high resistance in nature. We talked about this in the previous video, so make sure you go back and watch that, and we will do another separate video on just that specific topic. All right, so that is the PDF. This is your final example in the PDF. So here you have a higher time frame candle. You can see price reaches a higher time frame level, and then we like to see a reversal. Price. So if our example, right, if our drawn liquidity is this higher time frame external range liquidity, right? So just like we said here, if the monthly, weekly draw is external range liquidity, the lower time frame will offer internal range liquidity towards that objective. So what do we have here? The lower time frame internal range liquidity will offer trade ideas towards the higher time frame external range draw and liquidity, right? And then same thing here for the other side. Now this may be hard to depict in terms of the PDF, but we're going to cover some examples right now, and hopefully that can help you guys move forward with this kind of concept and help you guys understand better what exactly is going on. So that is the end of the PDF. Let's open the charts and get to it. Okay, we're going to start off with some very, very simple basic examples just to get you guys familiar with the concept. So over here, we have an internal range liquidity pool, and we have external range liquidity right here. And if you play it forward, you can see price seeks internal range and then external range. Why is this true? Because we're bullish, the range is likely to expand. You can see here, we take out the external range liquidity pool. Now, if you play this forward even some more, you will see something very similar. Now, we have external range liquidity resting over here, and we have internal range liquidity resting over here. So you can see we tapped it once here, we took out the high, and then we come back once more again, and we take out the buy side resting over there. So now, a lot of people ask me, can we reuse this fair value gap? Yes, you can reuse the fair value gap as an internal range liquidity pool. What you really want to see though, right, and if you refer back to the PDF, it's the fact that we took out this low, which is a form of internal range liquidity. So even if we did not have this fair value gap here, we can use this internal range liquidity pool, which is the short-term low, to facilitate this run higher towards external range liquidity. This is simply how the market moves. You also have this order block right here, right, and paired with this bullish fair value gap, and the short-term low. So this would deem a very good high probability run higher towards. Now, because we're also bullish on the higher time frame, you can also see we have external range liquidity taken out right here. So notice what we talked about in the PDF. If the higher time frame draw is external range liquidity, the lower time frame will offer internal range liquidity setups to take out the higher time frame draw. So if we know we're going to take this, we want to look for retracements into internal range liquidity and then runs higher towards external range liquidity, right? When the range is likely to expand, right? Let's go to the next example. Okay, so to the next example, we have the 15-minute chart here on the NASDAQ, and this is all from today's live stream, by the way. This is why I'm going over this example. You can see price took out external range liquidity right here. Now, what are we likely to seek? Well, we're likely to seek internal range liquidity in the form of this bearish fair value gap. But remember, what did the PDF say? If the range is likely to remain, then we will seek external to internal, right? But if the range is likely to expand, then we're likely to see external. So right now, if we're looking at this price action and we say this range is likely to remain, right? You can see we have a range, which is right here, just like in the PDF. And if the range is likely to remain, we should seek internal range liquidity. And what ends up happening, we have an aggressive run towards internal range liquidity. Now, let's zoom out this picture to the higher time frame, because on the lower time frame, this is the range we were looking at, right? But on the higher time frame, we actually have another picture. All right, so we're going to give another example. So let's move into the 15-minute chart and break down this example that we kind of had. So originally we were talking about this example and we were saying how price took out this short-term low, and now we have this liquidity and moving into internal. So if you zoom in, then yes, this concept is completely true. You can see we took out the external range liquidity on the 1-minute chart, and we seeked internal range liquidity defined by this move here. So external to internal. But let's zoom out a bit and understand really what range are we trading in, because this is only a trade idea on the 1-minute chart. If we go to the 15-minute chart, you can actually see we have a more established trading range, right? So let's say something like this. And if you look at if you remember what the PDF says, right? When your higher time frame draw is bullish and you have a higher time frame external draw on liquidity, you want to look for internal range liquidity setups. So in fact, this low right here is not actually external range liquidity on this time frame, right? On the 1-minute chart, this is external range liquidity because it is your dealing range low. However, on the 15-minute chart, this is simply a short-term low inside of this dealing range. So how can you navigate this price action? Well, if you're bullish and you have a higher time frame external drawn liquidity, you look for internal range liquidity setup here to external range liquidity setup there. How can you trust this setup? Because the higher time frame draw is bullish, and not only is this internal to external on the 15-minute time frame using this range, it's also external to internal on the 1-minute chart. So you have a confirmation here on both time frames aligning towards that objective. Now, obviously, you have to be bullish here to even begin looking for this idea, but hopefully you can start to understand how when you have a range on one time frame and on another, you have those setups kind of aligning and helps you depict which direction price is likely to go. And you can view them in multiple contexts, right? If you were trading this on the 1-minute time frame, you would simply look from external to internal. If you're looking on the higher time frame context, well, then you're actually looking from internal to external. And if you zoom out even more, obviously you have a more well-established range, and you can see we're likely to draw up towards this high, for example. And the more and more you zoom out, you get more and more information. I'm not saying keep zooming out forever and find your highest objectives. The idea is simple. You want to have a higher time frame draw for your higher time frame candle, and you want to look for setups intraday that align with that idea. All right, next slide. Okay, so we're going to do one full top-down analysis for you guys right now. So if you've been following the live streams, you know in the previous week we caught a lot of shorts targeting this October low, so a previous month low. So we have an external draw on liquidity, which means we want to see price give us internal range liquidity setups to target our external draw on liquidity, right? Now, if we zoom into, let's say, the 4-hour chart, what do we have here? We have a bearish fair value gap right here. we also have a bearish order block right here. So why is this a bearish order block? I'll annotate very quickly because I know some people will ask questions. Because we have an order block right here, and this candle trades into this order block, you can identify this as a propulsion block, which is basically a continuation order block. So this candle is an order block, and of course we also have this pretty large fair value gap on the 4-hour time frame. So if we want to align with our bias, we want to see price seek internal range liquidity and then offer external range liquidity setups. Now this is on the higher time frame. However, on the lower time frame, now listen closely, on the higher time frame, we're looking for internal to external, right? However, on the lower time frame, what are we looking for? We're actually looking for external to internal. So notice how you can use that kind of concept, and this is all in the PDF. So if you have to go back and watch and listen closely, this will help you understand all of that stuff. So let's zoom in to the 15-minute chart and see what happens. Okay, so here we are on the 15-minute chart. This big orange box is your 4-hour bearish order block, and these two red lines is your 4-hour bearish fair value gap. So remember what I said. On the higher time frame, we want to see internal to external. However, on the lower time frame, we want to see external to internal. It all depends on your drawn liquidity. If your drawn liquidity is external range liquidity on the higher time frame, then remember you want to look for internal range liquidity on the lower time frame to set yourself up for the higher time frame draw. However, because we have a drawn liquidity right now, which is more immediate, which is this 4-hour bearish fair value gap and potentially this order block, right? You want to look for external to internal range liquidity. So what does that look like? That would be this low right here, or potentially this low right here. And you would look for longs targeting that internal range liquidity. You can see what happens. Price accumulates going into pre-market, 930, takes out the external range liquidity pool, right? And after taking out the external range liquidity pool, you guys already know with the power of hindsight, we seek into that 4-hour fair value gap. And you can see how price already starts to react. But let's zoom in even some more. Let's go back to the 4-hour time frame and see how price forms this. So we ended up engineering a low here and seeking all the way deeper into this bearish order block, right? Now we still have this higher time frame external drawn liquidity. So we can still look for setups targeting, now listen closely, this old October low. Now, how did this form on the 15-minute time frame? So remember closely, if we're looking for internal to external on the higher time frame, then you want to look from external to internal on the lower time frame. Now, I don't really use this specifically in my trading so much. This is kind of a concept overview of just kind of understanding where the market is going to go. My model doesn't really rely too much with the lens of internal and external. I'm more focused on the power of 3 of the candles, the distribution, the manipulation, and that sort of thing. But I'll outline for you guys here. So now that you know you have a draw, right, you can see price offers you internal range liquidity setups via this retracement, right? So we trade into this bearish fair value gap, annotated as so, because you have to include the volume imbalance. You can see we trade internal to then external. And obviously, with the power of hindsight, we offer another internal external range setup. We're going to offer another internal to external range setup. And eventually, we will take out this October low. But notice how many setups you were able to take, because this is a large move. That is 1,400. And we caught shorts pretty much every day this week. And this was kind of what I was thinking of at the back of my head. Now, going into the market, it was more simple for me because I simply have a model that allows me to view the market very simply, where I basically say, well, because I'm bearish higher time frame, I have 4 criteria that I want to see for price lower, and that's how I like to trade. However, if you're using this internal to external range idea, because you have a higher time frame external draw, you want to look for lower time frame internal to external setups. Aligning yourself as so will give you a lot higher probability trade setups. So for example, you have one setup over here, you have another setup over here, you have another setup here, marking this out as a liquidity void, and then you have your final setup over here, again, marking this out as a liquidity void. And then you can see how many times we just simply internal to external all the way to our higher time frame draw. Now, like I said, we actually caught many of these shorts. It was actually a 5 out of 5 week for us on the live streams. And this is how I kind of was navigating it. Now, obviously, I don't trade this exact model. Like I said, I trade my power of 3 model, which we'll get to later. However, you can view them through the same context, right? This is all algorithmic to price delivery. It's all fractal. This is simply how ICT likes to teach. A lot of his concepts align the same. If you trade the market maker models or power of three, or maybe you just trade internal and external range liquidity, however you want to view it, they all view within the same lens. That's the beauty in it. It all depends on the way you want to go forward with your learning, with your model. Me, I personally love power of three. I love the idea of open, low, high, close, open, high, low, close. I like predicting your manipulation, expecting your distribution. I like trying to timing it with macros and candle openings. That's simply how I like to trade. I think it's very simple. However, this is one simple tool that you can use to understand where the market's going to move on the higher time frame and on the lower time frame, and you can how you can find setups to allow you to navigate that move. And you can see here on the, if you were to zoom out to the daily chart, all we did was simply trade into a bearish fair value gap and target the external drop. Very simple. I hope you guys learned something in this video. The next video will be about market structure shifts and breaker blocks. This will be your highest probability sign of a reversal. And the next video will be about the change in the state of delivery and order blocks. I'm hoping to post both of those videos sometime next week or in the near future. Until then, I will see you guys next time. Peace.